Welcome back. A very interesting discussion with Siddharth Vora, who's the head investment strategy and fund manager PMS at Prabhudas Lilladher. He also heads the quant business there, and we're talking about quant investing, which is definitely the future of investing. Okay, before the break, Siddharth, you were telling us about the do's and don'ts in quant investing. But tell us, what are the different kind of strategies and how do I build my corpus based on quant investing?
Sure. So there are multiple strategies one can construct using a quantitative approach. To start with, asset allocation. Like dynamic asset allocation is a very important global category which is run on quantitative basis. The second one is a long only equity category where you buy stocks and ride them without hedging it. So it's a long only category. The third one is the absolute return or a long short category where you have to make money irrespective of whether markets are going up or down. So you have to basically create a long short portfolio in order to make money on both sides of the market. So these are the three broad categories the way we see it: asset allocation, long only equity, and long short / absolute return. Within this, within long only category, the way we are going about evolving our strategies and products, we look at a top-down approach. That first you get the asset allocation right, because asset allocation drives 91% of investment returns cross-cycle period. Second, you get your regime right. Is it a value regime? Is it a growth regime? Is it a quality regime? Then you get your themes right. Then you get your factors right. And then you get your stock portfolio. So there are multiple decisions that a model needs to make for you. So within the long only category, we try to make all these decisions using our quantitative research models. And I think for an investor, a healthy mix of an asset allocation portfolio and a long only portfolio will help them navigate rough cycles also with good amount of ease. And if you know this, everybody is saying it, so am I, and my belief is there, that this is the year of asset allocation.
Yeah.
The macros are challenging, the inflation is challenging, the growth is slowing down, the monetary cycle is not what we experienced for the last 16 years. So there is a big change. In times like this, where there's tremendous uncertainty, asset allocation is literally the only answer to protect capital first and generate alpha later.
Okay, so before I ask you about asset allocation, how is quant investing different from, I mean, I know basically how it's different from passive funds, passive fund investing. But, you know, if I say that I want to remove all kind of biases, right? Familiarity, behavioral bias, I just go and invest in an index fund. It moves with the index, it takes care of all the biases. So why should I then go ahead and, you know, use a quant fund?
Very good question, Sonia. So passive funds are basically mimicking an index. And the advantage of a passive fund is that it's low cost. You don't need to worry whether the fund manager who does not want to buy metal stocks, real estate stocks, will be able to invest in them. Because when metal stocks do well, they rally 300% and your portfolio doesn't have it. So in that way, passive funds are effective. But the basis of quantitative investing starts with alpha, which means if you cannot generate alpha in a strategy across regimes, the quant strategy does not work. So once you invested 1.5 years in building a single strategy, the outcome of that has to be cross-cycle alpha. Only then it justifies managing public money. Otherwise, you cannot manage public money if you cannot generate alpha over passive funds. And our research shows us that on an average, when you do asset allocation right, or you get the regime right, or you get the theme right, or you get the factors right, average alpha over a 10-year cycle is 12%.
Okay.
CAGR basis.
Wow.
So
that's quite a bit.
That's a significant alpha.
Okay, since you said that the first thing that you need to do is asset allocation.
Right.
What do you think the asset allocation strategy should be this year? I'm asking you because, you know, I was doing a piece on gold. And I realized that in 5 out of the last 7 recessions, gold has given positive returns.
Absolutely.
If you look at the last 1 year, 5 years, 10 years, gold has outperformed the Sensex. So should you raise gold in your asset allocation
That's
strategy?
a very relevant question, and I might want to give a disclaimer. I'm actually managing a multi-asset fund in which we've increased our gold allocation from 7% to north of 20% over the last 3 months. And that has helped us obviously mitigate all the volatility around equities. And our strategy is currently, it's 51% equities, 21% gold, and the balance in debt funds. And within debt, we are gradually shifting from short duration to gilt. So for the last 2 years, we are positioned more in short duration and zero in long duration. And now we are gradually moving towards long duration as we feel that the rate hike cycle might be nearing an end or a visible end. So that is our strategy, but obviously as things change, as data changes, we might change our asset allocation also.
Okay, we have a couple of minutes left. So
Sure.
anything else you want to talk about in terms of size, performance, of the data for quant in India? What has it been in the past? Just for people who perhaps have never had any exposure to the quant side of
Sure.
investing.
So I think the most glaring data is that 0.35% of assets managed in India are managed using quantitative techniques. In USA, this is north of 35%.
Wow.
So that is the opportunity, that is the potential. And other than that, quant and passive combined in USA carry more than 85% market share.
Okay.
So as the world moves towards a more sophisticated way of investing, I think India also has to be a part of that.
And we have a stat here. In the
Yeah.
United States, there's a 12% growth that quant funds have seen from 2014 to 2019. Do you have any such stat for India as well?
Okay, so in India, the numbers are actually ridiculous because it's more like 100% CAGR because the base is
very
extremely small.
low.
So on a 100 crore AUM, if you go to 1,000 crore AUM, I think the industry size has gone from close to 800 crores pan-India quant to close to 24,000 crores in the last 5 years.
Wow.
So that's a huge jump, but CAGRs will be misleading because the base is very, very low.
Okay. And before we let you go, anything else that we've sort of missed out on in terms of what the ideal strategy should be in terms of quant investing?
The ideal strategy is never to focus on any one aspect of investing. It's to blend the multiple aspects of investing and follow a disciplined process time and again. Because whether you look at McDonald's, whether you look at MNCs, whether you look at Google, only processes can outlast people. And even in the Indian movie industry, you're seeing that content is now doing better than a star-driven movie.
Yes.
The audiences is changing their preference to see the big actor versus seeing a content-driven movie. And when processes start triumphing humans, I think even the investors will realize to choose a more rigorous process, a more intuitive process than trusting past performance of any fund manager.
It's quite scary, right? I mean, to think of a time when robots or when machines
This is
are
not
going to
robots.
just take over. But I get your point. I get your point. For an average investor, how do I get started on my journey in quant investing?
Okay, so there are multiple ways from mutual funds to PMSs to AIFs to small cases. But the idea is these are just platforms where you can find quantitative investment products, but how to evaluate the right strategy for you is very, very important. And I think we look at 5 things before evaluating if the strategy is good or no. One is, what is the objective of a strategy? Is it alpha generation? Is it absolute returns? Is it relative outperformance? What is the real purpose? Then the architecture. How is this strategy designed? Is it a ML-driven model? Usually, artificial intelligence and ML-driven models, they are black box in nature, which means the fund manager also doesn't know the rules because it's self-evolving. So when a model buys or sells something, you don't know. But that is not the approach we follow. We follow the rules-based, process-driven approach where every decision, every success, every failure can be attributed to why this happened. I have a cause and effect relationship for every decision in our models. So again, the idea is understand the architecture. Is it a math model? Is it a quantum mental rules-based model? Is it a ML-driven black box model? Or is it a passive model? What is it? Then you start looking at the performance characteristics of a strategy. And it's not only returns. It's returns, volatility, standard deviation, Sharpe ratio, Sortino ratio. These are some ways to evaluate on a cross-cycle basis, how does a model perform? What kind of drawdowns can it give in a bad cycle? What kind of alpha can it generate in a good cycle?
Okay.
And after that, finally, you look at things like fees and potential investment outcomes, and then you select the right product for you.
Okay, Siddharth, it was a pleasure speaking to you. Thank you so much. I didn't realize how half an hour passed. I mean, it was a really informative, a sort of primer on how to do quant investing. But folks, if you have any feedback, please write into us. We have to wrap up on this session of Smart Money. Thanks a lot for watching and have a great weekend.